Welcome to another Tax Talker and a happy Thanksgiving to you. I continue the series on tax write-offs as we approach year end, and for most small business owners, there's no bigger write-off you can get in one go than a vehicle. But here's the problem. Business vehicles are one of the most misunderstood and misclassified assets, both by tax professionals and tax softwares and DIYers. And when that classification is wrong, the depreciation and the accelerated depreciation is wrong too, and that can cost thousands. If you're considering a vehicle purchase before year end, it can make a big difference what you choose in terms of how much write-off you can get. And if you bought a vehicle in 2023 and 2024 and didn't feel like you got as big of a write-off as you were expecting, that may be fixable. Let's get into it. The foundation for all business vehicle write-offs are your business miles and business use percentage. Depreciation and write-offs don't matter until you know those two numbers. And the foundation for that is tracking your business mileage. There are a lot of apps out there that make this a lot easier than it used to be. If the IRS ever comes looking, they would expect you to have a log with date, business miles driven, and business purpose for each trip, documenting your miles for the year. In addition to that, if you want to be able to write off a vehicle using depreciation and your actual expenses, you need to calculate your business use percentage. That's your business miles divided by your total miles driven for the year on that vehicle. Now, this does not mean you need to track your personal miles. All that means is on January 1st and December 31st of the year, get your odometer readings written down so you can calculate that total number. And then you do need to have your business mileage calculated, and business miles divided by total miles, that's your business use percentage. That business use percentage is crucial in how this is calculated, because every business owner can just take their business miles times the IRS standard mileage rate. It's a posted amount every year. In 2025, it's 70 cents per mile. It'll probably go up a couple cents in 2026. So if you drove 10,000 miles, that's a $7,000 tax deduction. Where the business use percentage comes in is determining whether, instead of using that standard mileage rate, you can write off your actual vehicle expenses. In order for that to be the case, your business use needs to be over 50%. If that's the case, you could still take the standard mileage rate, or you can take your actual total vehicle expenses times your business use. Actual expenses include the gas, repairs, car tabs, insurance, but it also includes the depreciation of the cost of the vehicle, as well as interest associated with the financing of that vehicle. Total of all those numbers is your total expense for the year, and then if, say, you're 70% business use, well, then you get to take 70% of those as a write-off. Generally, the higher your business use percentage is, the more sense it makes to take actual vehicle expenses rather than the IRS standard rate. But let me say this, the IRS standard rate, it gets a bad rap. Everyone wants to write off a whole vehicle, right? And you can't do that. There are important positives to taking the IRS standard rate. For one, it smooths out your vehicle deduction. It's a known thing every year. You generally drive the same amount of business mileage, and it can be a pretty big deduction. As opposed to when you're taking actual expenses, you get a big write-off in the year of depreciating a vehicle, but then it's often much lower than the mileage rate. But more importantly, it keeps you from buying more vehicle than you need. If you want the nice vehicle and that fits into your broader financial picture, then sure, go for it. But don't make the mistake of saying, I bought X vehicle for tax purposes. It doesn't work out mathematically. The tax savings by writing off a much more expensive vehicle is definitely much less than the actual cost of that total vehicle. And the reason for that is that it's not that simple to take a big write-off on your vehicle. Congress knows that giving an unlimited vehicle write-off to small business owners is going to create perverse incentives and opportunity for abuse. So there are important limits in place on how much you can write off in year one when you've purchased a vehicle. But with some proper planning, there are some ways to work around these. Let's go through them. First, you have your luxury auto rules. If your vehicle has a gross vehicle weight rating of less than 6,000 pounds, then it's going to fall as a luxury auto. That gross vehicle weight rating, that's just posted by the manufacturer. That's what all this is tied to. And if you're under that 6,000 pounds, you're going to be unable to take any Section 179 depreciation on that vehicle, and you are going to be capped at the amount of bonus depreciation you can take. You may have heard from the One Big Beautiful Bill that bonus depreciation is back to 100%. There's still the exception on luxury autos. The way it works is basically any new vehicle is going to get you to the max, and that is $20,200 of a write-off in 2025. The rest of the vehicle depreciation is going to take place over the next 4.5 years. Practically any sedan, crossover, small SUV is going to fall within this range. You can easily Google that gross vehicle weight rating as your shopping vehicle. Second, we get to the SUV under the tax code, and that's a catch-all category. It includes your minivans, your pickup trucks. It is simply any vehicle with a gross vehicle weight rating over 6,000 pounds and under 14,000 pounds. And this is a much better category to be in because these vehicles can take Section 179 expense. They are limited to an annual amount. In 2025, it'll be $31,300. And then the rest of the vehicle follows normal depreciation rules, including bonus depreciation, which is back at 100% in 2025. So now an SUV can take the Section 179 write-off and then the 100% bonus. So you likely can write off your whole vehicle in year one. But pay attention, because that wasn't the case in 23 and 24. And there are states that don't allow bonus depreciation, so we'll get to that in a moment. Now, the SUV category in the tax code has exceptions built into it, and you can see these on screen. They're meant to capture vehicles like a transit van used as an airport shuttle. However, I do want to highlight a very important one up there is the pickup truck bed. Many standard pickup trucks like the Ford F-150 have a bed of the truck that is in excess of 6 feet as standard, and many other ones you can add that on pretty easily. And this does get you the carve out. And this is one of the most common things I see missed, is that a pickup truck gets classified just as a normal SUV. And if you meet one of these exceptions, you can take the full Section 179 write-off and that vehicle in year one. So that's, you buy a $60,000 pickup truck with the bed that is in excess of 6 feet. That's an automatic Section 179 write-off. And that was true before the One Big Beautiful Bill. That was true in 23 and in 2024. When bonus depreciation was limited. This is something you can amend your tax return and still go back and claim if you did not get the full write-off in those years. Also, it can make a difference in states like California, Illinois, Minnesota. Bonus depreciation is limited, and so it is far better to take Section 179. So the SUV, you get to write off $31,000 of it with Section 179, and then get to bonus the rest in 2025 for federal purposes, but for state purposes, you wouldn't get that larger chunk. And that could be, on a $60,000 truck, that could be another $30,000 you're missing. So it'd be very beneficial to get out of bonus depreciation altogether by being able to write off that vehicle if you meet one of those exceptions, including the truck bed one. That is the tax talker for today. The business vehicle deduction is one of the more complicated areas of the tax code that affects normal taxpayers, but it's worth hassling with because there are big write-offs available here. You need to be tracking your business mileage. That's true for all business owners. And if you want to be able to write off a vehicle, you need to be tracking your business use percentage as well. Be aware of those luxury auto limits. If you're interested in a pickup truck, that is a great way out of the SUV limitations on Section 179. If you want more information on bonus depreciation in Section 179, I did a whole video on that. As always, like, subscribe. We'll be coming out a lot more tax videos. Drop me a comment if you have tax questions. Thanks for watching. We'll see you next time.